All right, good morning. Let's go over today's trade plan. So in the overnight session, we saw that pretty much across the boards, the markets are really balanced, just within yesterday's range. ES retested the 86 quarter all-time high, yesterday's high, and found sellers there. But right now, even though we know bigger picture, the buyers are in control. In the short term, these markets can still go either way, with the big economic catalyst being tomorrow's employment number. Today could be a day where we break lower and we go down, test support, and then balance and bounce back up, or we can continue balancing here and then break out, go up to one of the resistance zones, either at 91.75 to 93.75 or 96, and then get responsive sellers active over there, and get a pullback back towards 86 quarter, heading into tomorrow's econ release. So today the picture remains similar to yesterday, except now we're even more balanced at these higher prices. So if we break lower, we could actually get a move down to the 69.75 to 71.75. So we're going to be watching, still NQ and TF to get a little bit of a heads up on which way this market can move. 36.67 is still a resistance level in NQ, and on TF we have resistance at 89 to 91. So if those levels get taken out in those markets, then it can put some upside pressure on the S&P, and we can get a break above 86 quarter and go up towards that initial resistance zone. We do have to keep in mind that the S&P is making all-time highs, so we don't want to be active on the short side above 86 quarter. And if we are going to take a short above 86 quarter, it's better if you time it with the other markets also hitting their respective resistance areas above these 36.67 in NQ and above the 89 to 91 in TF. So in TF we have some resistance closer to 1200, and in NQ if we break out above 67, then we don't really have any decent resistance up until like the 3690 to 3700 area. So perhaps as the other markets hit resistance, if ES is also hitting a resistance zone, then that's a potential short setup you can consider, because we're not expecting a trend day, especially to the upside ahead of the employment report tomorrow. So we will be keeping an eye on the markets, on NQ and TF to get a little bit of a heads up on direction, because if these other markets fail, then S&P is near the all-time high, and it can quite easily drop 10 to 15 points, and then we get buyers active again, right? So the first support zone in the S&P is 75.5 to 77.5, and that can still attract buyers, but the question we have to ask is, which side is the momentum leaning on as you head into that zone? If you're getting massive tick readings to the downside, then it's probably better to skip it. You want to be conservative in an environment where the markets are just very much stuck in balance, and it seems like they're just waiting on the jobs report to make a directional move. So if there's a lot of momentum heading into the 75.5 to 77.5, we can still get a short-term bounce, but you really only want to take the trade if it seems like initial support could be low of day, where the volume is still running below average, the ticks are low but not extremely low. It's like a minus 7,800 would be okay, and you can target a move back up to 83. But if it's like a massive liquidation type move below the overnight low, where a single bar takes you all the way down to initial support, like in a 5 or 10 minute move, then you probably want to skip it, because at that point that zone could give way, and you could head lower towards 69.75 to 71.75, and then that's where you can get a better bounce back into the previous range. So off the support zone at 69.75 to 71.75, or the 68 quarter breakout retest level, we can expect to bounce back up towards the 76 to 78 area. So that's a better spot to enter long, even if the market's shaping up to be kind of weak heading into it. On the upside, if we hold above like 81.5, above yesterday's VPOC, and then the other markets start to rebound as well, then there is still, again, bigger picture, the markets are bullish, so there's still that potential that we can break 86 quarter, and then go up and test the next zone, or at least try to make a push for that zone and then start balancing again. So, watch the NYC tick, watch the other markets to gauge what type of environment are we in. Right now we know that the market's very balanced, and you want to get involved really if there's either a clear sign that we're going to break below the recent balance and go down to 69.75. Then if you can get good trade location, there is a potential short setup in there too. But the other markets have to, break lower as well. And if they hold and they just kind of continue to balance up here and then start heading higher, then that's not a trade you want to be involved in. You don't want to be taking a short setup at the highs when the other markets can quite, put in a catch-up move. And so keep that idea in mind as well. But I think the theme for today, yesterday the idea was be nimble. If you're taking the setup, it's not working, get out, right? This is not an environment where you just get in, you just hold it and continue waiting. Today's theme is going to be about being more selective. Being cautious, being selective, understanding that this is, at the moment, not a, high reward to risk environment that we're in. There's a lot of chop, there's a lot of balance. Now, if you get a clear break and you're able to get good location, then, enter the trade. But if you miss the ideal location, right, then you want to be careful. You don't want to chase setups in this kind of environment where, there's a big econ release coming up tomorrow, and overall the markets are probably going to be balanced. Even if we break out, I think we'll get a rotation down. If we break lower, we'll probably get a rotation back up. So in this type of environment, if you miss the ideal spot to get in and you're late to the game, then you might be one of the last ones entering in that direction, and then the market puts in a reversal and you get stopped out. So be very mindful of trade location, and if you miss it, then miss it, right? Don't chase. This is not the market for it. We don't really have the volatility that's in play right now. We don't have the volume. But now if those things come in, if the volume does start to increase and the momentum does come in, then adjust and adapt, right? But by default, be selective. Unless you see clear signs otherwise, by default be selective. If you're unsure, be selective and be cautious. So that's really the main idea on the day time frame today. Let's see if the other markets can start going back up. So far they've been kind of weak in the overnight session. So let's see if they can start kind of maintaining some of these recent lows and heading back up. If that happens, then breakout in NQ and TF could actually put in a pretty decent move in those markets. Whereas ES is already quite stretched, so you probably won't see the magnitude of the move translate in ES as much as it can in NQ, because NQ from here can go up to 3691 or 3700. There's a lot of upside if it does actually break out. Whereas ES is already at the all-time highs, so there's not going to be the move is not going to be of the same magnitude as NQ can put in. So just keep that stuff in mind too. So overall, we'll watch these other markets. We'll definitely keep an eye on the NYC tick. Yesterday you saw it was very muted, and it was best to stay out. That resulted in chop. So today, keep an eye on it. If it shows you, a directional conviction in the market, and then the other markets are also confirming that with price action, then get involved. But otherwise, sit back and wait for a good spot. Try to identify one, maximum two good setups on the day time frame, and just take those, right? By being selective, it allows you to get aggressive when the timing is right. So, stay out of the mediocre stuff, focus on the high quality setups, and overall, let's see, if buyers can maintain control here. By default, we're still giving edge to the buy side, and let's just take it from there.